Friday, August 14th, 2020, Maneco 64, home of alternative economics and contrarian views. Many of you noticed that I didn't do a video yesterday. Everything's fine. I decided to take the day off. I went for a golf day at a very nice golf course, and it's about 40 minutes from here. My tee off time was fairly early, so I didn't have time to make a video. I came back fairly late as well. So today, Billy and I are back. There's no problem. And we're going to have another video later on today, UK time. I'm going to be interviewing Peter Schiff. That should be very interesting. So today, we're going to look at the bond markets. I think the bond markets are showing signs that things are getting out of hand for the financial market, for the financial system. And why do I say that? Well, because the bond market, especially the US Treasury market, is at the heart of the system. That's where all the other bonds, all the other loans are priced off. And I've noticed recently that the yields have started rising, which is a bad thing. The central bankers want lower yields. They probably even want negative yields. Even the Federal Reserve. I know they have been saying they don't want negative yields, but deep down they do. I think they need negative yields. So, and also the stock market, that's also priced off interest rates. The whole system is. And I don't think the central bankers are going to allow rates to rise much further. There will be an excuse, of course, for them to come in and increase the QE even more to keep rates pegged or even lower. They could come out and announce yield curve control, which is basically threatening the market with targets, so to speak. They could say, for example, the 30-year yield will not go above 1.5. They could say the 10-year will not go above 3/4 or 0.75 and so on. Yesterday, there was an auction of 30-year bonds, the long bond, and it didn't go very well. I worked in the bond markets for over 20 years. That was the market I focused on. When I worked out of Switzerland and then when I moved to London, I was a bond guy, so I know what I'm talking about the bond market. Some of you might think that I was in the precious metals market. Not really. I got involved in precious metals on a personal, private basis back in 2002. So yeah, bond markets are very important. I think they're showing signs of trouble. And again, the current crisis is going to be an excuse for the central bankers to inflate the system even more. And by inflating, I mean increasing their balance sheets, increasing M1, M2, and M3 money supply. There is a problem, though. I was reading a comment by someone yesterday. I forgot who it was. Someone showed a tweet. The problem is, this person said, is the lower you keep yields, the harder it is to attract investors because you're getting almost no return. We're starting to see prices, consumer prices rise. We're starting to see also the cost of living rise, and investors and money managers for pension funds, for all kinds of plans, they want more yield, more return. The thing is, if they boycott the market, the central banks are going to increase even more the QE, the money printing, so to speak, to keep those yields low. Why do they need to keep yields low? Because if they start rising, the whole house of cards comes down. No one will be able to finance loans, be it Uncle Sam, be it people who own houses and have mortgages, be it consumer credit, be it corporations. I mean, I saw yesterday that Apple, they're borrowing even more money. When you read the story, it says they're issuing bonds, but that is borrowing money. Why are they doing that? Well, to buy back their stock, because the people who run that company are not greedy enough. They're not happy enough with already what's happened in the Apple stock. But and they know that the central bank, the Federal Reserve, will be behind them if yields start rising. So yeah, they're just playing the game, and that will continue to put a rocket up the price of gold and silver and everything else that you can touch and is tangible. And why is that? Well, because the more debt the government creates, the more money printing the central banks do. That means the more currency around. So it's the law of supply and demand. When you have an abundance of something and everything else either goes down in supply or doesn't go up in supply as much as that fiat currency or that national currency, it loses value against everything else. It's that simple. So there you go. How long can they keep this going? How long? As long as the central banks are willing to keep printing money, to keep increasing the balance sheet. I've seen the ECB is continuing to accelerate quite a bit the purchase and the increase of its assets, really, balance sheet. The Federal Reserve has slowed down in the last month or so, or 6 weeks, but I think they're going to have to pick up their game. It's tough keying in all those billions or trillions, so they had to take a rest. So before I look at the markets this morning, more news here in the UK that convinced me this is an engineered crisis. And knowing that is one of the reasons I've decided this year that we're not going to go away, because what they did in terms of people going to Spain, they've done the same thing for France. So Boris Johnson announced last night, just after 10 p.m., that people who are in France, British tourists who are in France, they have to come back to the UK by 4 a.m. tomorrow morning, or else they're going to have to quarantine. So there you go. This is another nail in the coffin of the UK economy. We saw recently that the GDP here shrunk by over 20% in the second quarter. We're going to have a lot of unemployment once the furlough scheme ends in October. And I don't think the government is looking to continue that scheme, even though they could, because there's a lot of pressure from both sides of the political spectrum for the chancellor to do that. I saw a story as well the other day, because in the last couple of months or so, the government and the Treasury, they're trying to calm the markets down, saying that taxes are going to have to be increased. All the largesse they've thrown at the economy in the last few months because of a lockdown has to be pared back. But now we're hearing that there might not be a budget this autumn or fall because things are still uncertain, that they could keep the spending. So the same thing's going to happen here. And the Bank of England is going to probably pick up on the QE as well. I think there's going to be very little traveling right now. That's going to hurt even more the travel industry in this country. So now let's look at the markets, see where they are. It's 7:33 a.m. London. Gold and silver did very well yesterday. I noticed I did look a little bit after I finished playing golf and saw that gold and silver were up quite a bit. It looks like 1920 now is the support for gold. Well, it's always been, really, because that's the breakout level. That's the high of 2011. Yes, we did trade through that level a couple of days ago. We went down to 1860, but that was overnight in Asia in a thin market, while most of the people in the US and even in Europe were asleep or were not trading. So right now we're at 1952. I saw yesterday the high was 1967. I think in terms of short-term, very short-term levels, resistance, we've got 1974. That was an old high in the last couple of weeks. So keep an eye on that. Could very easily get through there today, I would say. Silver did very well yesterday. I think it was up 7% at one point yesterday. And it's trading in a very volatile fashion, which is normal for silver. But I think silver will be even more stellar than gold going forward. I think people are going to wake up to the fact that silver really is money. Gold is money, of course, as well. Gold is more of a savings instrument. Gold is a lot more valuable. And yeah, I think silver will become a lot more valuable. But I think people are going to go back to looking more at silver as well. As I've said before, the name of money in many countries has everything to do with silver. Even in the US, the dollar derives its name from the Spanish dollar, which derives its name from the thaler, which is a coin from Bohemia from the 1600s, a silver coin. We've got argent in French, as I've said many times, means money. We've got plata in Spanish, means money and silver. In this country, in the UK, sterling, the name of the currency, that's for sterling silver. So yeah, I think silver is going to come back. It's going to wake up from its long slumber as money. I think being money, and especially like day-to-day money, is the rule for silver. The last 50 years or so of not using silver coinage is an exception to 2,600 years of history, I would say. So silver is down a little bit today. We're down 53 cents. I'm not concerned really. It's down 2%. It's at 26.94. High's been 27.77 and the low 26.78. We've got the Dow future up 55.2%, 27.952. Got the S&P up 9 points, 33.81. And the NASDAQ 100 future is up 0.5% as well. The fiat currencies, we got sterling at 130.60, unchanged. The euro's at 118.17, also unchanged. So pretty stable at this time of the day. Dollar is down slightly against the yen at 106.83. And the dollar is down 0.1% versus the yuan at 6.94. So to finish off, I'm going to look at the bond market. I'm going to show you a couple of charts. The 30-year yield, you can see here. We had the 30-year auction yesterday. You can see that we've gone from almost 1%. We got down to 116 recently, and now we're almost back up to 1.5. That's not a very good sign there. You can see that during the height of the market mayhem we had in March, the 30-year yield spiked almost up to 2%. And there was also a spike back in June up to about 1.8%. So those are key levels there. We could very easily get up there to those levels. I think the Fed would be concerned if we go above 2%. The 10-year yield is doing kind of the same thing. We got down to 50 basis points. We had been testing that 60 basis points level that I spoke about many times. And we broke through there, and it looked like it was going to go down quite significantly, maybe even retest the low from March at around 30 basis points. But it's actually gone back up, and we're almost at 0.75%. And in terms of key levels, we've got the spike back in March. That was to about 130, and in June, that was to just under 1%. So those are the key levels. That's what we need to keep an eye on. And I think there will be events out there in the outside world. I don't know what they're going to be, but that are going to warrant the central banks to come in and start buying these certificates of confiscation, as I think I forgot who called them that back in the 70s, Treasury bonds, and I think also John Exter called them IOU nothings as well, because they're backed by nothing, U.S. Treasuries. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.